Good evening, everyone, and welcome to Endowus 2026 Market Outlook webinar. My name is Yulin, and I will be moderating the session today. Thank you again for joining us as we look back at 2025's market performance and, more importantly, explore what lies ahead for investors in 2026. So we know many of you have questions about everything from, artificial intelligence to the valuation of the equities market, and we have assembled two exceptional fund managers. And before we dive in, a quick housekeeping note. Please take a moment to review the important disclaimers. On screen, we have quite a lot to go through. And this presentation is for not be considered as personalized investment advice. Now we want to make this session as interactive as possible. So throughout the webinar, please submit your questions using the Slido link. Just go to the link and you can input Outlook 26, and you will see that you can input your questions all throughout the sessions. And in the end, we will do live Q&As. So don't be shy. And let me quickly set the context for today's discussion. So at Endowus, we are a digital wealth platform, and we work with over 100 global leading fund managers, and we are manager agnostic. So it means that we focus on selecting the best-in-class funds from each manager, and we also, create solutions using their funds in order to serve our clients' needs. But we don't just provide access to funds in the most cost-effective way. We also provide direct access to the fund managers sometimes, and that is exactly what we're doing now today. So we have invited two experts from firms with exceptional track records to share their insights to help us navigate 2026 investment landscape. Next slide, please. So I'm really delighted to introduce our speakers officially here. They have been waiting, I know. So we have Andrew Li, Investment Director from Capital Group, and we have Jingjing Huang, Senior Vice President from PIMCO. Now, Andrew and Jingjing, would you like to introduce yourself a bit more and also your companies?
Should I go first?
Yes, Andrew,
Or
please
Jingjing,
go
you want
ahead.
to go first?
I think Andrew, you might want to go ahead first.
Okay, sure. Well, first of all, a huge thank you to Endowus for having us, and also a huge thank you to the audience for spending today's evening with us. I'm Andrew Li, Investment Director here at Capital Group, and if we could just quickly go to slide 14, I think. There's a quick snapshot of Capital Group. So Capital Group is one of the most experienced asset managers in the world, as we've started managing our clients' assets since 1931, which means that we have more than 90 years of experience investing in the world. Essentially, that's our mission as well, and that is to improve people's lives through successful investing. Now, I'm quite sure that even though I can't see all the folks that dialed into the call, that some of you are not very familiar with or have not heard of Capital Group before today. But I think a lot of you here would have heard of MSCI, the global index provider, right? Well, we Capital Group actually put CI into MSCI in the first place. And what does that even mean? Well, CI stands for Capital International, and that's us. And it's really all the way back in the 60s, given our investment experience of investing in global markets, we've decided to pioneer and publish market index covering global equities. And it's until late 80s when Morgan Stanley came into the picture, licensed the right to the indices, which later became Morgan Stanley Capital International Indices, aka MSCI. So in that way, Capital Group might actually have been part of your financial journey for quite some time without you actually noticing. So we are one of the most experienced. We are one of the largest asset managers in the world as well. As you can see here, we're currently manage about 3.2 trillion US dollar of assets. And within that 2.7 and 2.6, I would say around 2.6 to 2.7 billion US dollars is in equities. Last thing that I really want to highlight is the fact that we are very much aligned with our investor, with our clients' success and interest. Part of the reason is because we are a private company, hence providing long-term stability and also allowing us to deliver strategic priorities that are aligned with our clients' goals. But the other reason, which is a little bit more, I would say, interesting and unique, is the fact that our investment team, portfolio managers and investment analysts, they are remunerated entirely based on their investment results over 1, 3, 5, and 8 years, while other factors such as their asset under management are not really part of the compensation equation, which essentially means that they have a very clear focus on delivering one thing, and that is really great investment results over the medium to longer term, which is what our clients and our investors look for when they entrust their money with us. And that's it. That's the intro of Capital Group and a little bit about myself.
Great. I didn't know about the CI story. That's really interesting. Okay,
Great to
Jingjing, do
hear.
you want to introduce PIMCO? And I realized I think Capital Group is the largest equity manager, and PIMCO is the largest fixed income manager, right?
That's right. Good
Yes.
evening, everyone, and thanks for having us. I think in Endowus, you guys always have the best access to the managers, and very honored to be on the panel together with Andrew. So, PIMCO is the largest active fixed income manager in the world, and as you can see here, we have a total AUM of over 2 trillion US dollars, and we manage the assets for clients across the world. We are also a global platform with our investment professionals sitting across Americas, EMEA, and APAC. And apart from the traditional fixed income that you probably would imagine PIMCO would do, because we're quite famous for being the bond king, but you would probably also be pleased to find out that we actually manage multi-asset strategies. We also manage private and alternative assets for our investors. Although we started our business by working more with the institutional investors like endowment funds, pension funds, and insurance companies, but recent years we had grown a lot in the wealth management market, and also has grown a lot in the Asia Pacific market. So I know the name of Endowus is really to bring the institutional mindset of investing to wealth investors. That's what we are doing here in our wealth management market as well. And then just one last point about the views that we're going to share later. It's collective wisdom from our all investment professionals and also from our investment advisory board, which currently is chaired by Gordon Brown, the former UK Prime Minister, and also some members to highlight. Janet Yellen, who is the former Fed chair, is part of our committee. And we also have Dr. Richard Clarida, who used to be the previous Fed vice chair. So we do have all these expertise from our advisors to contribute to our views. So we're very excited to share the latest outlook tonight with you, and please feel free to ask us any questions.
Great, thank you so much. So before we get into your forward-looking views, let me set the stage by quickly reviewing what happened in 2025. I won't take up too much time, I promise. Next slide, please. So 2025 overall was a great year across asset classes, and you're generally rewarded for taking risk. So equities did really well on a full year basis. Commodities obviously also delivered stellar results, and fixed income, depending on where you are in the spectrum, you will be getting either mid-single digit or even high single digit return. But this is not without volatility. So, sorry, can we just go back quickly? Yeah, just wanted to point out that there was bouts of volatility in April, for example, and we also had US government shutdown in Q4, for example, and that created some volatility in the market as well. Next slide. Yeah, and in terms of equities markets, regional performance, it was kind of a year of surprise in that US equities actually delivered it was still really great performance, but it was kind of the worst performing region compared to the rest of the world. You can see that Asian ex-Japan equities actually dominated return in 2025, and that really highlight the case of regional diversification. The next slide, please. In terms of sectors, over the full year, materials and communication services were the top performers, and material sector was prepared by the strong performances in metals and mining, which has a high beta, high exposure to the gold prices, silver prices, etc. And communication services benefited from kind of the excitement around the development in artificial intelligence. And next slide. So just quickly going into fixed income a little bit more to dissect the drivers of return in terms of rates and credit spread. In 2025, the left-hand side of the chart, you can see how the US Treasuries curve shifted from the yellow line downward to the blue line. So rate came down, especially on the front end. There was a general steepening of the curve, meaning the front end came down more than the longer end. And in terms of spread, it was generally quite range bound apart from April's episode. And it was, yeah, just, I guess, slightly tightened over the full year. And yeah, credit spread, basically, if you have exposure to that, the premium paid off. And next slide. So this is kind of the sector performance breakdown for fixed income and emerging markets that was the top performer in 2025, helped with, solid improving economic fundamentals and I guess the outflow from the US to emerging markets, as well as kind of the currency stories there. That's it for the 2025 review. So now let's shift our focus to 2026 and address some of the most frequently asked questions from our clients. So we have structured today's discussion around 5 key themes, and let's go straight into it. So the first theme is gold and real assets. And we have already actually received a lot of questions on this. Well, gold remains firmly in the investment spotlight this year, not only because of the strong rally last year, but also because of its heightened volatility in the past 2 weeks. So I wanted to ask, what were the key drivers behind this? And on top of that, how should investors practically think about allocating to gold and more broadly to real assets? Jingjing, would you like to take this first?
Yeah, sure. Thank you, Yulin. So yes, we have prepared one slide that basically illustrate how crazy the gold price has moved. If you look at the first chart, this was as of December 30th, so at the beginning of this year. And if you would update this line chart, which is the gold spot price, it would also be much higher and above this 5,000 mark. But overall, what are the reasons behind this extraordinary rally? We think it's basically the behaviors of the buyers have been shifting over time. So first of all, with the central banks and particularly some of the emerging market countries, as they foresee more volatility and uncertainties in the geopolitical scenario, there is this like diversification away from the US dollar. Although we don't think gold is going to replace the US dollar as the global reserve currency, but we do see the moves incrementally. And if you look at how the central banks has been purchasing the gold, which is the yellow bar on the left-hand side, you do see that central banks they actually have been increasing over the last 3 years. So Rome is not built in one day. And we also saw that this is also the first time in 20 years where the US Treasury's holdings among the central banks as a reserve is lower than gold. But we do think that's more because of the gold price spiking up rather than the big shift in terms of the volume. And we are also more recently seeing more of the market concerns on Fed independence and fiscal sustainabilities. So all of that dynamics has been reinforcing the role of the gold as a more of a strategic asset. But we do think there will be more volatilities going forward. There might be appreciation, but there will be short-term volatility. And we think investors should really consider the gold or the broader real asset exposure as a way of diversifying from your core holdings in the portfolio. We don't think it's a wise idea to put all your eggs in gold. We also don't think in terms of the risk adjusted return, uh, that's a good journey. Think about how much the volatility has been. But we do think like real assets as a way to effectively help people to protect from further inflation would be a nice diversifier from the core holdings in your like fixed income and equities holdings. So we also recommend having a broader basket of inflation protection instruments rather than only focusing on gold. For example, precious metals, there's a variety of options for you to consider, and the financial instruments, including like TIPS, basically the inflation protection treasury bonds, would be another way to protect against the inflation increase in the future. So, in short, think about it in a way of diversification and look at how it's going to help you from inflation hedging, and think about real asset in a broader way. It's not just gold, but also other commodities and real assets, as well as the TIPS inflation protection bonds.
Great, thank you. That's super helpful. Just wanted to ask Andrew if you have anything to add on this.
Sure. I definitely agree with what Jingjing has said. I think gold can be one of the many asset classes to diversify clients' overall portfolio exposure. And I think that there are also increasing signs of gold transitioning from a largely cyclical rate-driven asset to one that it's now seeing and supported by more structural drivers, driven by a managed control monetization in which gold regains potentially a more formal monetary role, but without dismantling the fiat currencies or the credit system, which is also something that I think Jingjing alluded to earlier on. So, meanwhile, if I look at the current setup, private demand and conducive macro environment, such as the heightened geopolitical conditions, you also have the real interest rate and currency dynamics, especially the US dollar, and the signaling effect from central bank behaviors, as well as the ETF flows. I think all these sort of add to the case for gold to be more welcome, to be integrated into a broad portfolio construction. But that said, the recent volatility in gold prices highlighted that it is really one of the most crowded trades, which therefore warrants additional caution. In terms of expression of equity investment ideas, I think gold streaming companies can be attractive opportunities given the lower operational risks and strong cash flow visibility, alongside a measured increase in operating leverage. Given the fact that these gold streaming companies, they don't really own the gold mines, they provide funding to the mines, and in return get to buy gold and commodities and in a much discounted price compared to the spot price. And I think that just gives these companies a lot more, I would say, a lot more safety, given the fact that they don't really underwrite the assets, but at the same time, in an environment where there seems to be a much more stronger structural driver for gold at repricing, these companies just seems to have a much more structural growth profile going forward.
That's a very interesting point. Okay, I think we've spent enough time on gold, and there might be some more questions coming from the live audience later, but let's move on to the next topic, which is another big topic, which is artificial intelligence. Well, there has been a lot of enthusiasm around it, but there has been also a very sharp run-up in the stocks related to this theme. So, question for you, are we witnessing a technological paradigm shift, or is the bubble nearing the burst? Andrew, would you like to start off on this?
Sure. I think I'm more in the camp of a paradigm shift rather than a bubble. I think a lot of the concerns around whether we're in an AI bubble or not could be based on two things. One is just the huge amount of AI related capex that these AI companies are putting into the ground. The other is signs that the current AI cycle could resemble what we've experienced back in the dot-com bubble period in the late 90s, which was definitely very scary. But if we could just unpack them one by one. So first up, if I look at the huge amount of AI related capex back in 2024, the big four hyperscalers in the US have spent more than 200 billion US dollar in AI related capex. That represents about 12 to 15% of the total revenue. Last year, 2025, the same big four hyperscalers in the US has spent more than think around 330 billion US dollar in AI related capex. And that represented a little bit more than 20% of the total revenue. And so while these capex numbers, right, 200, 300, going this year, 400 billions, these numbers are huge. But because these hyperscalers growth are also very hyperscale, their revenue and cash flows are also growing very rapidly and very much in line with the growth trend with their AI investment. And so these investments don't really look out of whack to me. And essentially, these capex is critical for them to keep delivering the growth that they will need to support and satisfy the AI demand that we're seeing growing almost exponentially within a short period of time. And then the second thing, which is drawing parallels with the dot-com bubble period, I think there are definitely similarities, and the market narratives are quite focused on the frothiness and exuberance, predominantly from a valuation perspective. But I think fundamentally, there are two things that are quite different now compared to then. One is a much more favorable demand and supply dynamics. When we are meeting with all these AI companies and hyperscalers, we are hearing two words from them, and it is capital constrained. And what does that mean? That means that they have the legitimate demand for AI compute, but then they are just constrained in terms of providing enough supply of the AI capital, the AI infrastructure, and the AI compute power to support these AI demands. And so I think that demands mentioned a little bit earlier on about the earnings growth and the revenue growth of these companies are very much in line with their AI capex growth trend. And so it's very different compared to back during the dot-com period where a lot of the fundings is actually relying on debt or other off-balance sheet financing channels. And so I would say that we're more in a paradigm shift rather than a bubble period. So in terms of how that impacts investment from an equity standpoint, I think it's still very important to acknowledge that valuation is stretched for quite a few of the AI related companies. But that said, their fundamental outlook remains really attractive, and the moat that some of these companies have, such as leading semiconductor manufacturers, high bandwidth memory manufacturers, and some of the integrated infrastructure and model manufacturers, they are just really strong, their mode, and really competitive. And I think that just provides much more earnings growth visibility going forward that help underwrite those higher valuations. But I would also encourage investors to take a step back, look out of the AI stack. So on this slide, just sort of move away from the left. I'm sorry, the previous slide, please. So a little bit moving away from the left-hand side, which is the AI tech stack that everyone talks about, to focus more on infrastructure providers. Some of the utility companies, they are in a very beneficial position to really benefit from the much higher energy and electricity use, given the fact that if I look at the US, Right now, data centers accounts for only 4% of US energy demand, and that's expected to grow to about 9 to 14% by 2030. And then we also have industrial companies there that provides electrification, heating, ventilation, air conditioning to data centers to run 24/7, 365 days. And last but not least, I think our investment teams have been focusing a lot on what are the second derivative impacts, what are some of the long-term adopters of AI, which can really impact and bring positive implications to the bottom line and also margins outlook. And we're starting to see some of the signs of reward coming through in some of the companies within financials, media, and healthcare companies. So really about investing selectively in an AI tech stack, be very cognizant of the valuations, but also focusing on the bigger picture, focusing on the long-term beneficiaries because they could be the long-term winners of this AI paradigm shift.
Great, that's super insightful. I know Jingjing PIMCO doesn't really, I mean, PIMCO does invest in equities, but your specialty is in, fixed income. But I'm sure you still have something to say about this really important topic. Do you?
Yeah, thanks for sharing, Andrew, and thanks, Yulin. We do actually, I think, first of all, our short answer is quite consistent with what Andrew just shared. We don't think it's a bubble. We do see that the demand coming from AI-related capex, as you are seeing on this page, these are the real demand, and these will be sustainable demands going forward. But for PIMCO, from more of the credit perspective, how we look at the AI opportunity is also quite interesting because we do believe there will be good borrowers coming into the market, but there will be the weaker borrowers. So as we lend money to these projects, to these borrowers, we wanted to make sure that we do our due diligence and look at who are behind the deals and who we are actually taking the risk behind that deal. So one of the headlines from last year was so far the biggest like data center financing deal that's the key borrower is Meta, which is the parent company of Facebook, I believe everybody knows. And they have this 26 billion US dollar of financing in need because they were trying to build this super data center in Louisiana. So with that big gap of the financing, they have to find strategic partner to be able to provide that amount of money. So we did our due diligence. We think that we are essentially taking the risk of Meta, which is one of the leading tech players in this space. And we structure the deal in a way that's a senior secured note, and it's also innovative enough to have to carry the flexibility of a private credit deal, but also it has the liquidity of a public credit deal. So the valuation we negotiated for our investors was also very attractive. So if you compare with the other Meta outstanding liquid bonds in the market, the deal we negotiated with a valuation of extra yield or spread of 1.5%. And so that means we get that additional yield for our investors. And once the notes got traded in the public market, that 1.5% was able to close very quickly. So our investors was able to capitalize on the differentiated value that we created. So this is really a way to illustrate how PIMCO is taking an important part in this whole AI development and how, as the largest active fixed income manager, we are able to capture those opportunities and also with our pricing power and with our strategic partnership, we can create instant additional value for our investors.
Thank you so much. And I think this actually segues to the next topic really well, which will be focused on fixed income primarily, but of course, there's some Yeah, for income investing, it's both fixed income and equities, but fixed income is very prominent asset class for investors who are interested in getting that passive income from bonds and credits. So I think a concern from investors or the question is with the rates having coming down, is fixed income still an attractive asset class for income seekers? And I think, Jingjing, you are the best person to answer this question for us first.
Yeah, sure. I'm happy to start. We can turn to the next page because I think the yield advantage is really something that fixed income as a class can provide at this moment. So yes, people are looking at rate cut, but if you look at the yield right now in the market, the yield has not really come down, and even if we refresh this page until end of January, you're going to see an even more attractive picture with the yield level still at historical elevated level. And what does that mean for investors? So first of all, it still provides that window for investors to lock in the attractive yield that's provided by the market. And looking forward, it also means there's a higher chance for investors to generate a better return on a 5 year forward looking basis. Why are we saying that? If you look at the correlation number in the middle of the chart, 94%. So what does that mean? So this is your starting bond yields and your 5 year forward returns correlation. And we run that historically all the way from 1976. So that means the higher starting yield you can lock in, the higher forward-looking return investors should expect from a high quality global bond market. And in addition to what you're getting from your starting yield, you can get additional capital appreciation from the fixed income market with the rate cuts cycle continuing, and also with the market's uncertainties going, and people might shift more to the fixed income as an asset class. So we do think the year of 2026 is giving the fixed income a very good position to start, and especially for people who's focusing on the income generation, which we think should be part of your investment objectives as well. And then moving back to page 6, another thing I would like to share that's also related to what Yulin has shared at the very beginning. So we continue to see the yield steepening. Most of that has already happened starting from 2024. So our portfolios have been positioned in a curve steepener, and we have already benefited from this position. But if you look at the implication of the new Fed chair candidate, we do think that there is more potential for the short-term rates to come down. And what that also means is investors who used to put their cash with the fixed deposits, they do need to find better alternatives because the rates are going to be lower. And for investors who wanted to get the same level of the yield, they just have to find other assets. And we do think like within the fixed income and being actively invested in the fixed income market, it can still provide that level of income generation.
Great, thank you so much. So obviously, fixed income is a relatively conservative asset class for income seekers, but I think one space that income seekers tend to overlook a little bit is actually equities, where you can actually get additional capital growth in the long term as well. So I wanted to ask Andrew, for investors who are willing to take on more risk for both income generation and more capital growth, where in the equity universe are the most compelling opportunities that you are seeing?
Sure. Well, great question. And I would say that in the equity market, dividend stocks are an area of the market that can offer opportunity, both in terms of valuations and long-term dividend growth potential. Valuations, I think a lot of the folks here in the call would hopefully agree with the fact that just dividend stocks, in terms of valuations, are relatively cheap compared to the broader market, especially when we compare that against the IT sectors or AI-related sectors. So there is quite a bit of potential for re-rating as the broader backdrop of the macro economy seems to be pretty resilient. In terms of dividend growth potential, is the fact that if we look at the recent quarters, we saw financials, software, and transport companies being the main engines for dividend growth. And on a going forward basis, I think one thing that the market hasn't really talked a lot about is how the improving corporate governance and the maturing of many strong free cash flow companies across the world. So not just in the US, we're seeing that in Europe, we're seeing that in Japan, starting to see those coming through in Korea as well as in China. These just means that for investors that are looking into the equity market, looking for income or dividend, you have an expanded opportunity set. And for one, the IT sector has been one of the key dividend growth contributors in the last decade. And so I think that's just something that I would say is very exciting for dividend investing going into 2026 and beyond. But I think that going back to growth, right? If we can just go back to that slide that has the 4 secular trends. Yes, correct, that slide. So quite a bit of dividend and income opportunities are also encapsulated in these 4 secular trends, which we think over the long term would provide a lot of structural growth opportunities for investors that would like to position them within their global equity portfolio or just simply their overall portfolio. So starting on the top left-hand side, artificial intelligence, we just spent a lot of time on that. So I'm not going to repeat that. But then the other one is moving to the right-hand side, industrial renaissance. That's just getting much more love from investors, starting from last year, when we started to see that there's quite a bit of fiscal impulse going through in Europe, and that translate into quite a bit of increased spending on defense. And so some of these defense companies could provide really strong growth profile going forward as defense spendings across the world is unfortunately increasing. The other is really some of the companies that I mentioned earlier on that could benefit from the data center capex and the data center build out, such as heating, ventilation, air conditioning, as well as companies that provide utility and energy and automation support. And then if we go clockwise, going to healthcare innovation, last year, not really an area that most investors really want to be positioned in, but we think that going forward, valuation is also quite attractive. But then there are just a lot of structural innovation within the healthcare sectors, companies that have really strong pipelines. I think some of the folks here would have heard of and quite familiar with the GLP-1 drug companies. So this year, I think one of the exciting elements is that now we could potentially see the oral version of GLP-1 in addition to the injectable. So that could unlock a lot more value for some of these companies. But it's not just GLP-1. You have oncology. You have some of the genetic therapeutics coming through into the market. And I think that just underwrites quite a bit of structural growth opportunities in healthcare innovation that investors shouldn't give up on. And finally, it's just the evolving consumer trends. Yes, consumer, not really exciting. But then I think what's really exciting is the paradigm shift. So going away from goods and products to more services and travel-oriented consumer. So travel and tourism, some of the online travel agency, some of the aerospace companies, as well as some of the cruise lines companies could be bright spot that could benefit from this structural shift in consumption trend going forward. So quite a lot of opportunities. And I think, one last thing that I really do want to wrap up is the fact that we think that market could broaden out from here. Looking at the valuations, looking at the earnings backdrop, I think that just means that there are just a lot more opportunities for equity investors to find great areas to get exposure to these secular trends. And so dividend, income, and also growth, you have it.
Great. Thank you so much. And this is really great perspective. And it also actually links to, I guess, the next topic that I want to bring up, which, well, will bring us back to the US equities market, but this time we will be focusing on just the valuation story, right? As the valuation ha is historically stretched, and I think investors are worried if they are entering the market now, they will be buying, or there is a risk of buying near the peak. So, what do you guys think about it? What other approaches that you are taking, that you would, yeah, kind of recommend to the investors generally?
Yeah, maybe I'll start first. I think this is a question that we got last year about whether it's a good time to be entering the market when market is at record high. I think that's also a little bit like a question that we've been asking ourselves, a lot of our clients definitely back in 2024. And to give you a bit more context, right? S&P ended up having about 40 record highs since Liberation Day in April last year. And if I go even further out, if I look at 2024, so from 2024 all the way till now, we have almost, don't quote me, but I think we have almost 100 record highs. So I don't think a record high is a sign that investors should look to in terms of when to time the market. And also, I don't think the record high is a prelude to a reverse course as long as the fundamentals of the equity markets really is strong and resilient. And as I mentioned early on, if I look at the earnings growth going into 2026, still pretty resilient. So I don't think this record high should be something that stop investors from investing in the equity market. Now, is there a risk? Definitely. But I think there is more risk for investors going to US if you go into passive or you take a top-down approach when investing in the US. So what we're showing here essentially is to look at the valuation discrepancy between the S&P 500 IT sector on the left-hand side versus the S&P 500 X IT sector. And then on the right-hand side, we're also comparing the valuations on the basis of 12-month forward price to earnings between Max 7, S&P 500, and the median. And I think the common theme here is that it's really that Magnificent Seven is really the concentrated part of the market, like the IT sector, that has been lifting the overall S&P or the overall US equity valuations. The rest of the market are still pretty good in terms of pretty reasonable in terms of valuations. And so I would encourage investors when thinking about and when constructing your exposure to the US equity markets, definitely do because there's still quite a bit of structural drivers in the US market. And we haven't really talked a lot about productivity growth driven by AI. And I think that, over the longer term, by the end of the decade, we could potentially see productivity growth double from here. And that will lift economic growth in the US. And that just set a really great setup for US to do well. To be more selective because 10 out of the 11 gig sectors do present quite a bit of not just valuation, but also earnings opportunities. And so some of the secular themes I mentioned earlier on, like industrials, healthcare, and changing shape of consumer patterns, I think these secular trends provide quite a bit of opportunities that we're seeing outside of IT sectors.
Great. And Jingjing, do you have anything to add on this topic?
Yeah, sure. Just supplementing what Andrew mentioned, I think there is one slide that I have in my deck, which is page 5, that addressed some of this question. And so if you look at the US equity valuation, I think it is page 5 of my slides. It says amid elevated US equity valuations, where we show the equities. That's
Yeah.
right. Thank you. Um, so as I mentioned, because we also manage equity assets as well as multi-asset strategies, we do have a view here, but basically we think that the valuation for equity is expensive on the surface. But if you look under the hood, there are quite some values for people to capture, especially across the globe. So on the left-hand side, that's consistent with what Andrew shared. Outside of Max 7, there's more opportunities. Within Max 7, you can see like some of the stocks are already almost off the chart in terms of their valuation. So these are probably some of the stocks we don't want to put too much of a weight on. And then on the same value chain, actually, in order to capture the technology trend and the AI trend, we found more attractive and interesting opportunities outside of the Max 7 and actually in some of the Asian countries, for example, in Taiwan semiconductor, in Korea semiconductor. And these are some of the hidden gems that we try to discover in our strategies. And then on the right-hand side, you can also see if you evaluate different markets based on their PE ratios, you can also see that the more reasonable valuation comes from the developed markets outside of the US and also some parts of the emerging markets.
Thank you so much. Now let's move on quickly to one of the last topics before we yeah, try to take some live questions. I'm not sure how much time we have left because we are kind of tight on that. US dollar. I think we are seeing at least amongst our client base, some investors starting to worry about, having over concentration in US assets. And it's often amplified by concerns over the US dollar depreciation. I think especially for Singapore investors who went through last year's movement. So do you have any thoughts or to share on US dollar and how can investors effectively diversify their portfolios geographically?
Yeah, sure, I can
Yeah,
start.
great.
Yeah, so I do share that experience of US dollar weakening with Singapore-based clients. This week, I'm in Taiwan right now. The Taiwan clients also probably were even more so with the strengthening of the Taiwan dollar. But a quick way of conclusion of our view on the US dollar, we still think it's the cleanest dirty shirt. And what that means is investors are still going to rely so much on the US capital markets. And with the geopolitical uncertainties going on, we still think that a lot of the global like pension funds, they are going to rely on the US capital markets because this is the only market that's big enough to absorb and with the breadth and the depth for those investments. So we still think that US dollar and US assets are important. But we also think this is a very important reminder for people who previously probably have only put their assets in the US or within US dollar to think about, is there anything else I can do? And we think definitely because it is an era where global diversification matters a lot. So as I mentioned in the equities valuation, you see more attractive value outside of the US. And we also see that in the emerging market bonds area, there are interesting pockets of opportunities for people to capture. And one interesting phenomenon that we saw over the past year or two is that when people talk about rate cuts, when central banks talk about rate cuts, we saw that the emerging market central banks, they are sometimes much more reliable and predictable than the developed markets central banks, particularly the Fed. So what that means is also it presents the relative value across the globe for those markets that we think there's more certainty in terms of rate cuts and more attractive yield opportunities, then we take the active approach to capture those opportunities as a way of diversifying from one single country exposure. And that's also why on the next page, page 9, you would see how we demonstrate our framework when we look at some of the countries. For example, we look at countries on two dimensions. This is really a simplified way of illustration. So the horizontal axis is the fundamentals measured by the basic balance as a percentage of GDP. So the higher, the stronger fundamentals. And then we also look at the valuation, which is the vertical axis. That's basically the real yield that you can get from the market. So over the last year, we have seen capital flowing from countries like US to higher real rates markets in emerging markets to capitalize on that yield differentiation. And that also helped the return and the performance of emerging market. We do think that trend will continue as people seek additional yield and look for global opportunities. So some of the examples that we have here includes Brazil, South Africa, and Peru.
Great. How about you, Andrew? What do you think?
Yeah, well, I think in the near term, there is definitely some cyclical or technical signs that point to the weakness of the US dollar. But over the longer term, I think there are still very much structural support for US dollar, reserve currency status. And I think essentially there's still just a lot of demand for US dollar assets. If you look at the equity markets at this point in time, um, I mean, globally, which are the trillion companies, right? The 5 trillion, 4, 3, 2, 1 trillion companies, predominantly, if not all, they're all U.S. companies, and I think they continue to do very well, and that just continue to attract foreign capital into the U.S. dollar asset on the equity space, but also in the fixed income space. So I think there's definitely that position there that I don't think over medium to longer term we'll see a major deterioration from that. But then I think also at this point in time, what's very interesting is the fact that we are seeing market broadening away from IT and also away from the US. I'm not saying that IT in US they're not doing well. I think they're doing well, but it's just that other markets are also doing relatively well as well. And so if we could go to, I think it's my slide 6, or essentially slide 33 of this pack, where the title is that company profits are expected to rise across the globe. I think what's very interesting to see if we can go to that slide is that earnings growth across the world, it's improving, and US is still probably registering about 14% earnings growth this year, but then Europe, Japan, emerging markets, and China is also growing. I think this slide that you're yeah, this is slide, and then this slide's more or less on a sector level, but essentially the message is the same. Outside the information technology sector, you also have the other 10 out of 11 gig sectors that are expected to grow their earnings by at least 7%. And that just means that there are quite a bit more opportunities. There are quite a bit more exuberance outside of the IT sector, but also more health in the broader equity markets. And so I think that just underpin the case for being diversified in terms of building your equity exposure. But last but not least, I think is really an and concept, not an or investment concept. I think a lot of the clients of Endowus, you have great resources here in Endowus. Similar logic applies where you can have multiple investment solutions in your portfolio and Endowus, and the same logic applies to when it comes to investing in the equity market. You can have both U.S. but also non-U.S. In order to build that really robust portfolio that could navigate both volatility and also opportunities. But the key is really be selective and therefore be active.
Yeah, thank you so much. I just wanted to, I guess, add on here and reiterate actually at Endowus, we've always been a strong advocate for global diversification. And that means You have exposure not just to the US, but also to the rest of the world, emerging markets, Europe, etc. And our portfolios, all of our portfolios, the core ones, the flagship portfolio, our Endowus income portfolios are designed that way to give that global diversification because I think investors are always just tempted to chase the next big thing. But generally, when retail investors are chasing the next big thing, it's a little bit late. Hence, the long-term investors should really be focusing on just building a robust long-term portfolio with that global diversification to withstand different bouts of volatility. Another point on, I guess, US dollar depreciation and how investors practically can manage it. Um, uh, there's, of course, the currency diversification, which you will get if you diversify your portfolio globally. But for example, we provide Sing dollar hedged options, especially for fixed income, because if you are a Sing dollar investor and currency volatility can really overwhelm your fixed income return stream. And it's not really ideal, especially if you are a conservative investor. Whereas for equities, generally we recommend clients to have a long-term view, and equity inherently is a more volatile asset class as well. So currency volatility doesn't dominate your return stream, and you still kind of get most of your volatility from equities exposure, and you have a longer time for currencies to kind of mean revert if it happens in the long term, and go through that volatility. Yeah, so I think that's how we help our clients manage, the noises or, the different shifts, cyclical shifts by just staying focused and stay invested with the right goals in mind. And I hope that actually addresses some of the questions that we have been getting live. For example, how do you get exposure to emerging markets and what's the panel's view on emerging markets? I think we kind of talked about it quite extensively. And we know we have a hard cutoff at 7:30. So just wanted to ask the panel, do you have any last few kind of advice to give to our audience today?
Yeah, I'm happy to go first. I'll be very short. I think, as what Yulin mentioned, stay invested, stay globally diversified, and also in this part of in this time of the market, stay up in quality because you actually don't need to take on too much risk. You can already lock in a pretty decent yield level that you won't be able to get if you look at 2, 3 years ago. So this is really the time for investors to think about broader diversification and asset allocation.
How about you, Andrew? Do you have anything to say on this?
Sure. So you've heard me say a lot of great things about equities, but I do also want to to sort of bring up and caveat that there will be quite a bit of volatility. It's not going to be a one-way ride up for equity investing, and so and so I do want to remind investors that it is really important to stay invested. Is really time in the market, not timing the market, that can lead to successful investment outcome when it comes to equity over the longer term. So if you look at the chart on the left-hand side, we've done some homework. We look at the previous 70 years of the S&P 500 index returns. Typically over a year time, there will be twice where the market will have a drawdown by about 5%. About 16 to 18 months, you see the market have a drawdown by about 10%. So this is really part and parcel when it comes to equity investment journey. But then what's also part and parcel, it's the market always rebound. And typically during the rebound phase or the bull market phase, the duration and also the returns gained during those period would be much longer and also much bigger, respectively, compared to the drawdown period. And so when you try to time the market, and I think the closest example is really around the Liberation Day, when perhaps you try to time the market, you get out when market went down right after Liberation Day, probably you won't be agile enough to get back in on the 8th or 9th of April when market then had a recovery. But then if you miss just 9 more best trading days in the chart on the right-hand side, you can see that over a 10-year time frame, just by missing that 10 best trading days, your investment value compared to staying invested over a 10-year time frame will be down by almost 50%. So once again, stay invested. It's really timing the market, not timing the market, and be selective, be diversified.
Thank you so much. I think you can be our advocate. It's exactly what we believe in as well. And just wanted to thank the panel again for your time this evening. I know, Andrew, you actually have to catch a flight, so I
Correct.
don't want to keep you here. And yeah, and again for all the audience participation, if you have any more questions, please feel free to email us, and we will be here to answer you. And again, I think investing comes with a lot of behavioral biases. And as a retail investor, trying to do personal investing well, I understand all of these pains, but I think over time I realized it's not about doing it perfectly, but actually doing it with discipline and just try to be an average investor, and you will do really well in the long term. And with this, thank you so much and wish you a good evening ahead.
Thank you. Bye.
Thank you.